Our main types of SBUs are cost centers, revenue centers, profit centers, and investment centers. So cost centers are the support departments. We don't generate revenues, but there are costs. So this is the accounting department, human resources, information technology, and any area that we have marketing, sales that doesn't generate revenues but has a lot of costs. Revenue centers focus on the selling function. They might have their own product line, so we might have divisions separated by product line, or we would have regional areas, so a Midwest area or Northwest area. Profit centers have both revenues and costs. An example of a profit center would be an individual location of like a retail entity. So if we think about Casey's, we have two Casey's in Waverly. Those are each going to be a profit center within an organization. And then investment centers. So investment centers include operational control of assets by the manager. So the manager has the approval to purchase property, plant, and equipment, where with a profit center, the manager is just responsible for revenues and expenses and has no control over major capital purchases. The choice of whether we have a profit, cost, or revenue center depends on the nature of our own firm and how our firm is set up. So cost centers, these would be manufacturing support departments, and then some of the other centers that I talked about. Some of the strategic issues with cost centers are one, that we would have cost shifting. So this is when if we're being judged on our ability to control our controllable costs, which would be our variable costs, but we're not being judged on the amount of non-controllable or fixed costs, where we would start shifting to be heavy in our fixed costs. This, of course, is not good for the business as a whole or the business in a long term, but it would help us short term in cost control benefits. So again, one of those, we look at short-term cost figures. So we make a lot of short-term decisions. We might create budgetary slack. And while budgetary slack can be good, too much slack is not good and is demotivating to employees. When we're looking at implementing cost centers in production and support departments, we can have a discretionary cost approach or an engineered cost approach. So in an engineered cost approach, our costs are mainly variable and controllable, and the firms use an output-oriented evaluation focus. The focus on evaluation is these well-defined outputs. In a discretionary cost approach, most of our costs are mainly fixed and uncontrollable. So then we look at an input-oriented planning focus. So some things that cost centers can be looked at is their ability to provide support, how many support hours they provide, who, how beneficial are they to an organization as a whole. Those are different things that we would evaluate a cost center on. When we have cost centers in general and administrative departments, we have two methods to choose from. So one, if we're looking at cost reduction, so we have that the human resources department might be treated as an engineered cost center if we're really looking at cost reduction as a key objective. if we're looking at discretionary costs to motivate managers, we might be focused instead on the achievement of long-term goals. So what we want to look at is what we value from those support systems, what we're looking for from those support systems, and what kind of input and outputs we expect from those support systems. Cost behavior is usually a step cost where our costs increase at specific levels versus a totally variable cost or totally fixed cost. Many firms choose to outsource the items that they might have cost centers for. So this is becoming more and more popular, especially services like customer service, accounting, payroll services. So if we have a cost center, how should we allocate the cost of service departments to departments using the service? So we've looked at allocation methods in several different chapters where we have the step method, the direct method, and the reciprocal method. So we need to choose an allocation method based on its ability to motivate managers and encourage goal congruence and provide a basis for fair evaluation of the manager's performance. Dual allocation can be beneficial because it separates fixed and variable cost. So we would look at a contribution margin income statement when we do divisional analysis. So with dual allocation, then variable costs are directly traced to the individual departments and divisions, while fixed costs are allocated on some kind of basis. So we can use activity basis, which is what we're going to look at in some of the chapter examples, or as I said, we can go back to previous chapters where we had the step, direct, and reciprocal methods of allocation for support departments. Revenue centers generate revenue. So the things that we're looking at for revenue drivers are looking at our sales volume, price changes, promotions, discounts, our customer service, any changes in product features, and anything along our value and non-value added factors. When we're looking at revenue drivers, we're in service firms, we're focusing on the quality of service. So what service was provided and how did the customer react to the quality of it. A marketing department can either be a revenue or a cost center. So if we have a revenue center responsibility, this means that the marketing department is responsible for revenue generating and produces revenue reports. Or it can be a cost center. The cost center things are advertising, promotion, packing, shipping, warehousing. We can also have a lot of things within those advertising and promotion costs. Profit centers, as I mentioned before, our main goal is to earn profits. So an example of a profit center would be an individual location of a retail market. We can also have profit centers within, if we think of a large department store, we can separate them out into individual profit centers where we would have like men's clothing, women's clothing, jewelry, makeup would all be their own individual profit centers within that single department store. So the issues that we're looking for there is that we want to have the incentives that we motivate the sales, and we're also trying to control costs. So we want to make sure that our managers are motivated to earn a profit and control costs but in ways that support the organization as an entire whole, and not just in ways that support the division or just get our manager a bonus of some type. So we have cost leadership and differentiation, which we've looked at before. So in cost leadership, we want to control our costs. We want to be the lowest cost. And in differentiation, we're competing on some kind of differentiation, whether it's more features or higher costs, some kind of high quality that we're providing to our customers. When we're evaluating divisions, we use a contribution income statement. So this separates out our variable and fixed costs. We would also separate out our fixed costs into controllable fixed costs and non-controllable fixed costs. So what fixed costs are controlled by the actual manager and which ones are not controllable because they're set by contracts or other things. When we create our controllable margin, that's the contribution margin minus our controllable fixed costs. So the contribution margin income statement can be used to help us determine if we should drop a profit center or if we should drop a product line. One complication in preparing statements is that not all costs are extremely traceable at a very detailed level. So we have this example of a contribution income statement here, where we have the company as a whole, and then we have Division A and Division B, and then Division B is broken down into 3 product lines. We also have a line where we have non-traceable fixed costs that can't be traced to any particular item. Positive values on this contribution income statement mean that the profit center is covering all of its traceable costs, both variable and fixed. So that's the contribution by profit center. So we want that to be a positive number. As we can see when we're looking here, product 3 is not covering its controllable cost, variable and fixed costs. So when we're evaluating this controllable performance of a manager, the controllable margin is preferred since it excludes those non-controllable fixed costs. Remember, we don't want to try to evaluate managers on things that they have zero authority or control over. So this, when we look at whether or not a profit center should be retained, it's not only the contribution margin, but what kind of loss we would have from dropping the product line. So we saw from product 3 that we had a loss from the line. However, we do have a positive effect. So we can see here that we do have a positive $50,000 contribution margin for this item, our controllable margin. What is causing a loss is the allocation of those non-controllable fixed costs to that product. So if we removed product 3, which looks like it's operating at a loss, we would actually lose more money because where we're seeing that loss is in non-controllable fixed costs.